Hi, everyone.
Hi, everyone.
Welcome to today's presentation of Understanding Market Corrections. Most of you guys know us. I'm Colette Snyder. This is Joanne Holst, our certified financial planner.
Hi, everyone.
And we have offices in Lakewood and Lone Tree, and we do these classes about twice a month right now. This one we haven't done in over a year, but we thought it'd be a good time to bring it up. We've got some exciting classes that are coming up this spring that I'll be sharing with you at the end of the presentation. And Joanne's going to go over some of these topics here today about understanding market corrections and a little history lesson.
Yeah.
So if you have questions, you can type them into the chat box on the right-hand side. I'm going to have a little fun. I'm going to do some polls and maybe a little quiz. And just try to get you to interact with us a little bit. It's a little less snoozy that way.
What?
And if you're,
There's snoozy?
It's, if you're watching this as a recording, you won't be able to interact, but there is going to be a button beneath this video on the landing page where you can click to schedule a consultation with Joanne, a complimentary consultation. If you want to talk about your own investments or any other questions that you have, we'd love to be a resource for you. So now I need to scooch it closer because she says she can't see.
So I need yes.
There we go.
Okay, daughter. Okay, let's hit it.
This goes down. Okay, ready, set, go.
Okay, all right. So this class, I love doing this one. We go back in history so that people understand what can be expected when you're in the market, if you're investing in the stock market. What has happened in the past so you understand what can happen going forward. And that's really important. When we work with anyone, we really try to have them understand risk. And risk is basically how much are you willing to risk to gain a certain amount. And the higher the risk, the higher the potential gain in the future. But your account could go down more than you're comfortable with. So I want to just go through history and show what are norms with corrections, bear markets, all of that, and a lot of information I think you'll understand if you're in the market, which most of you are. What can you expect so you don't make decisions that might upset some of your investments? That's probably one of the main reasons we do this. So I'm going to click there. And there we are. We are a family-owned business.
Mm-hmm. This is my mom.
And that's my daughter. So we'll keep moving ahead here. So
I mentioned we're independent fiduciaries. We're in Lakewood and Lone Tree. Most of you on this call already know us. Some of you might not. But yeah, that's us. That's Matt. He's my husband, and he also works with us. And so does Bob. Grandpa Bob down there. He also works with us as well.
And we're all fiduciaries, putting our clients' interests first. So that's very important to us.
And the two cutest little grandgirls.
And they are. They're way too fun. That's our disclaimer. Disclosures, things like that. So go ahead and speed read that one.
Yep, these are opinions, general information only.
Okay. Whoa, a quick
poll. How much of your investable assets are in the market? So what I'm going to do is I'm going to share a poll on the right-hand side of the screen. You'll see these questions pop up, and you can answer the poll. The options are all of it. How much of your assets are in the market? All of it. More than half, less than half, less than 1/4, and my mattress is my market, which is kind of a joke for saying you don't have any money in the market. Maybe you have all your money in something like a CD or a savings account or someplace that has no risk.
Annuity, a safe
or
annuity.
An annuity, yeah.
There's some that are very, very safe.
And we can keep moving along as people are answering this, but it's just kind of fun to see. It helps us also kind of tailor the presentation to what sort of risk takers we've got online here.
Yes, ma'am. Here we go. So let's talk about these terms. There's a lot of terms. We try to demystify some of these terms and speak in plain English is our goal. So when we talk about a market correction, there's 3 levels of that, where the stock market is going up, up, and up, and then it pulls back from its high. And it depends on how much is it pulling back from its high. And generally, these are shorter term types of things. And we'll go through all of that as we go through this webinar. But there's a pullback, which is generally 5 to 9%, a correction, which is 10 to 19%, and a bear market generally is 20% or more. Again, there's a bull market where the market's going up. Bear market is when the stock market is going down. So we're going to see how often these actually happen. They're very common. And I want to say the stock market generally is up 80% of the time, but it can't go straight up and up and up and up. It has to pull back and revitalize and have a stable platform for it to go up again. And we'll show you some of those things.
The analogy that I always liked was it's like a yo-yo on an elevator.
Ooh, very good.
Like it goes up, but then it's kind of going up and down as it goes up. I like that analogy.
That is a really good one. It is a good one, but it has to pull back for different reasons. We'll look at that. Let's look at history. So there have been 125 market corrections from 1900 to 2017. So basically we have at least one every year of a market correction. Bear markets happen basically almost every 3.5 years. So it's normal for that to happen. Thing is, you don't want to be pulling money out. I mean, when we create income streams for our clients when they're retired, we're not pulling out of things that are going up and down. We're pulling out of something more safe, and then we have more risky things for the out years. But it's very common. It's normal. And it's common. You have to be comfortable with how much that happens, what kind of pullbacks for your money, but you want to understand that it's common and it has to happen. Here's a graphic of bull and bear market since 1925. And just at a glance, you can see the bull markets are in blue. So obviously they're taller, longer. There's how many months they lasted in there. Like this first one, second one here says 167 months of a bull market. It was followed by 6 months of a bear market. So the red is the bear market going down, the blue is up. And you can see most of the time we're in bull market territory, but we do have pullbacks. So what can trigger a market correction? Many things can.
Quiz.
We have a quiz.
Okay, now we're going to test your knowledge here. True or false? Historically, the type of political party leading the country has played a significant role in market performance. What do you think? Do you think which party is in office greatly determines what the market's going to do? I'm going to pull up that quiz right now, and you can take a swing at it. Right-hand side. What do you think? Do you think it's true or we got one for false? One for true. Okay. We'll give them a second to answer this one before you reveal.
Yeah.
Historically.
Yeah. And we did a webinar a few months back that we looked at through time some of these actual numbers that some of you were probably on back then. Yeah. So bottom line is it's not really what party is in office. It's where we are in the business cycle, which repeats over and over and over and over and over again. It depends on where we are in there. And do we make changes, though, along the way as policies change? Absolutely. If we're talking about some increase in taxes in certain areas, we will do, if that happens, we will, contact everyone. We'll do another webinar on what kind of accounts would that affect? What could you do now, to do anything? But also if taxes increase, other things can happen to offset the economy, like infrastructure spending. That helps the economy. And that looks like that probably will be happening in this administration. More stimulus that stimulates the economy. So there's things that offset, but just one political party in versus another does not determine what happens in the stock market. But we do make tweaks along the way, always. We do, as soon as we're aware of them. So what can trigger a market correction? Profit selling. People, big institutions need to sell some things and rearrange and all that. So they're taking profits off the table. They feel like certain investments have already evaluate or increased in value. So they might be selling, taking profits off. We do it all the time here. Corporate earnings, if corporate earnings are really great, generally the stock goes up. If they're not, the stock can go down. There's a lot of people that do technical analysis, charts and graphs. We do that along with fundamental analysis, which is really about the economy. We do both. But technical analysis, charts and graphs, it might signal that something's going to happen, and people, just because of charts and graphs, sell or buy, either way. Fear is a big one. Fear is a big reason that people panic, and they might go to bonds or go to gold or go to cash and things like that.
And this next one is not about the ballet.
It's not about the ballet. Yes, this actually happened last year with the coronavirus. We had a black swan. It's something that came out of nowhere, and it's very uncommon, like black swans are apparently.
Yes.
And we had the fastest drop in the shortest period of time in history, down 35%. But then we had the fastest recovery in history also. So some people are calling that a bear market because it was more down. It's down more than 20%, and some are saying it was a big correction. But we're way past where we were back then. But those are unforeseen events that happen.
Yeah.
So here we go. So what does a market correction mean to my investments? It's normal. You want to not panic. We don't want, the fourth bullet, remember, buy low, sell high is not buy high and sell low. You don't want something barreling down and sell it at a low price and locking in a loss. The types of investments we generally invest in are not disappearing and going away. Newer, smaller companies, that can happen. If you invest, they could just totally disappear. Generally, when you're investing for retirement long term, with things we do, they don't go away. They have a bump in the road, and they do come back. And generally, what we had is a lot of clients putting more money in when the market was down. And we send out market commentaries often. I think when we're going to have one come out tomorrow. So you don't want to sell when it's down. It's going to generally come back up, and it's normal. So you have to be that. But the lesson here is, for the volatility, it will, like Colette said, a yo-yo on an escalator, not an elevator.
It just doesn't strike quite the right imagery.
Not quite.
Yeah, the escalator gives you kind of a better picture.
It is. You need to know, how comfortable are you with the ride, the yo-yo going up and down, because it will head up over time. The market, again, is up about 80% of the time. If you're not comfortable with the ride along the way, the short-term bumps, then that's okay.
And we'll have a quiz about that. We'll have a quiz about that a little bit, how you're feeling about your current risk dosage. And remember that this slide is about a market correction. So this is that. What was that figure again? What was the percentage? 10 to 19%.
19%. Yeah. All right. Here we go. So there's certain investments that have a higher risk and some are lower. And we measure that when people come to us. We do an analysis of what's the risk they're taking now. Is every investment has a risk associated with it, a volatility of what it can do in the short term. They all have it. So if it's too bumpy along the way, then you would have a lower risk that wouldn't be as volatile, be a little less gyration. So, and then there's things that have no risk. And a lot of our clients, we have things invested that have zero risk, some risk in the market, both. So we offer ideas and things, pros and cons, and we go with that.
And how does someone determine their risk comfort level?
Well, for one, we send out Riskalyze. We use a program called Riskalyze, and it's great. And it's we send it out through email, and you answer some questions, and it's a very different approach to risk. It'll look to see how much money do you have to invest, and are you willing to gain a certain percent? Say you have 100,000. Are you willing to gain? To get to 10%, you'd have 10,000 in a gain, but on the down side, are you willing to potentially lose 10,000? So it's more about the loss. What might you be comfortable with that? None of us want to take a lot more risk than we need to for our retirement.
And I think the problem is a lot of us don't really know what that means. Like you might consider yourself risk averse, but then you don't know how to translate that into, okay, well then what types of investments are right for me? And that's why this tool can be really powerful, because it can use a little bit of psychology to help you understand how you feel and then help us match you with the appropriate investment so that you don't stay up at night and you have a good feeling about your investments.
You want big surprises. You want to have, okay, this is happening. This is part of, what I'm in, kind of thing. So just education is everything. And that's what we try to do, is educate everyone. I love this. You can read just about anything you want in the online or whatever in the news. Everything is great. Everything is horrible, whatever. Don't listen to the news and all. Really have a sound plan. We do investments. We put it together in a lifelong plan for all our clients. So, and then we revisit that often to make sure you're on track where you want to be. That's what we see. A big thing is people are not putting it together in a plan. And that's really big, because you want to just plan as much as you can so you have success for the rest of your life, basically. And you can sleep well at night, as we say. So if you are normal,
are you normal?
Yes. No. Okay. No. Anyway, if you're normal, this is pretty interesting. The investor, it's a cycle of how we're feeling about our money all the time. You can see over on the left, as accounts going up, we're getting optimistic.
Wow, I'm smart.
Well,
everybody has that moment, right? We're like, yes.
Yeah, and unfortunately, a lot of people get in. If people who are a little risk averse, they don't want to miss out though either, and they might get in. My sister did this. I remember about 2000 or 1999, 2000, got in finally, and it was near the top, and then basically it did nothing for a while. But euphoria is the top, where there's generally a lot of euphoria. Everyone's going crazy and everything, and you might peak out and have a downturn there. But these are just some emotions, and we're feeling despair and depression and all that, and then we're getting excited again. It's normal to do that, but you need to know this all is part of what's happening. And that's part. If you're in the stock market, it will go up and down. How much are you comfortable with the ups and downs is the big question.
And I think a lot of that is just, getting educated like we are today, and just having that awareness and knowing that that is normal and that it is predictable. And that maybe might help you from making some of those rash emotional decisions.
Yeah. And again, when we're planning for folks, we don't want to be overly risky with anyone's retirement funds. Now, you might have something that, okay, this account here, I want it. Let's go for it. All these exciting technology companies and all, but you want to have a good, stable plan of things that are, somewhat predictable. This is one of my simplified chart.
Yeah, that's super simple.
Simple. Yeah. So you can see, I'll just go through it real quick, but you can see the blue lines along the way. Just dive in the middle of that graph there. The blue line is the time that we're in a bull market, and the red orange is when it's in a bear going down. Is there more blue or more red?
This helps my analogy. It's a very long escalator in this image, but it definitely is headed to the second floor.
Yeah, so that's, through time, that's what's been happening. That's from 1940. I'll show you a few more slides, a little bit more information on that. But generally, ultimately, the bear retreats.
That's a bear butt.
That's a bear butt, Oh, goodness. This is maybe the most important chart right here that I want to talk about. This is talking about what happens after a bear market. So the bear market's going down at least 20% or more. This is the bear market bounce. So this is showing over on the left. It says the year pretty much of where it was the peak, and then the bottom of the trough of the bear market. So you can see the first line lasted 7 months. A bear market going down. Whoa, it went down. We generally look at the S&P 500. Index, that's 500 of large US-based stocks, and that's very broad-based, so we're measuring things against that generally. So during that bear market, the market declined 14%. Here's what happens is people panic and it goes down, down, and they get out. But the big gain in return is usually with the next 12 months, which is the last column there, S&P 500 gain, 12 months later. If you look at this first line, it declined over 7 months, minus 14%. And if you panic and you got out, and you're waiting, I'm going to wait until that thing comes back, and you wait, and you wait, and you wait, and you wait, and then you miss it. Here's the 12-month period later, it was an increase of 38%. And that happens over and over and over and over again.
So the takeaway for our viewers is
you can't time the market. You cannot time the market. That's why you need to understand what you're in and what it can do, and not try to get, well, I'll just go to cash. Well, now you got to make two perfect decisions. When do you get out? When do you get back in?
Yep.
So, and people miss the bounce. It was the fastest rebound in history was last year from the whole COVID thing. So here we go. So anyways, and if you look at the average, the median down at the bottom of this, the average bear market was about 9 months, 9.72 months. And the decline averaged minus 26% during that time. But the 12 months after that, it returned almost 35%. And if you're not there, you're going to miss out on that. So you don't want to time the market, get in and out. You need to understand what you're in and what you can expect it to do so you don't make those mistakes.
Have a plan.
Yeah. Okay, great. But I still want to move to cash. I can wait this out. I've had a few people ask. We educate our clients. We do a pretty good job with our market commentary. We've done this before. But moving to cash, again, you have to make two perfect decisions. It's hard to make the one. Nobody has a crystal ball around here. What to buy when the markets go up. I should change. I should do things, right? We do make active changes for our clients based on where we're going in the next couple of quarters. So we do make changes if they make sense. And Colette has here.
Yeah, I'm going to, I meant to have this for you to download, but I wasn't able to get it in time. But I am going to put this link in the chat box. And this is just a really great little summary of our presentation today. If you click on the link, if you go to the chat box and you click on the link, hopefully I shared it publicly. Yes, I did. If you click on the link, it's going to take you to a handout that's called Navigating Market Volatility. It's all about perspective. And it's a really great little summary of what we've been talking about today. If you want to share it with someone that maybe couldn't make it, or you just want to, kind of brush up on some of the things you learned, click on that link and you'll be taken to this PDF, and you can print it out.
It's a good document. Thanks. Okay, so here is, we call this.
We kind of talked about this a little bit here.
It is, but here's the timing thing. So you look on this little graph, you go over to the left, the market's going up and up and up and up, and everyone's happy. Starts going down, 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 and here's the little arrow there. It says, I want to sell here when it's down because I'm not comfortable with the volatility. But I plan to get back in when the market clears up right about here. And see that second arrow is you've lost a lot of, if you got out of the market, you lost a lot of the rebound.
So they call it investor dyslexia,
yes,
which makes sense, right?
It does, and because we're afraid, it's fearful, we're going to lose money and all that. But that's why so we do this education, because it rebounds, and as long as you're not actively pulling money out all the time, you want, again, to pull it out of something safer. This is what's going to happen. You need to understand that that's normal, and
not make emotional decisions. Yeah.
Timing the market doesn't work. Again, I already said this a few times. You have to be right twice, and it generally doesn't work. We got a new client recently because they said their investor, their advisor, took them completely out of the market last year, and then missed the return on that, the rebound, totally missed it.
I imagine a lot of people did that. There was a lot of fear at that time.
A lot of fear, and that's why we're in constant contact with our clients, because we want to make sure that they know we're here for them, and we'll explain what's going on. Here's another graph too, a bar graph, time in the market versus timing the market. So time in the market is very important, not timing the market.
But does this mean buy and hold?
Well, we do make we always make changes. We have active management, so we're looking at lots of things. If we're an investment, again, we think that it's done a lot, has a lot of growth. We might sell and take profits and all, but generally, what we're looking at is the next 2 quarters. Where are we again in the business cycle? If we're and plan and invest in sectors that represent what does well in that part of the business cycle. Like if we're in a recession, people aren't out there buying cars and spending a lot of money on expensive luxury things. They are paying their utility bill, their medical bills, their telephone. They're buying toilet paper, as I always said, the consumer staples.
So much toilet paper.
Yes. Well, that was kind of funny. Well, it wasn't funny, but that's what I always use for years is buying toilet paper like mad. But anyways, but those types of stocks do better during a recession, and then you have growth, and so you have extra money now. What are you spending your money on? So those industries are how we switch as things change, because they're changing over time. We don't stay put, buy and sell. We don't day trade, but we are trading based on where we are, where we think we're going in the next few quarters.
Yeah, and we're just trying to make a distinction here between the time in the market and buy and hold. That's not what we're suggesting here, that you just stick it out no matter what you're in. But this graph does show the difference between time in the market and timing the market.
Yeah, because you're going to miss. If you're out, you're missing some of the days. This first bar is you're in during the full period. The market, 12.5%. But if you're missing some of the biggest up days, this is just, let's see, this is taken from 1980 to 2015, some data from the S&P 500. If you miss 10, 20 of the biggest days up, you only get a 7.2%. If you miss 40 of the biggest days up, your average return would only be 3.7, and on and on. So just got to know what you're in. Got to know what you're in. There we go.
Oh, yep, David Bach, we like him.
Great books. And this graph, okay, so this is a graph of different types of investment groups you could be in compared to each other. So this is over time, 1926 goes up to 2016. I can read that.
You want me to read this for you?
No. No. Kind of know. Okay, the green. No.
Quiz.
Mr. Green Line. No. The green line I know is inflation. Inflation increases over time, and when we're planning for anyone with your expenses and your budget, we build an inflation in down the road so that you still have enough income from your investments to pay your bills and live your life. So inflation happens. That's the green line. The next line is some bonds, short-term bonds, and
Treasury bills,
short-term bonds, how well they do. See how flat a line is not very volatile at all, is it? But you also don't get a big return. And the numbers, I think, are back over here. You could probably read that for me. But the next line up is a longer term. It's a longer term bond. But the red line is large companies like the S&P 500. And see how bumpy it is along the way, right? It's bumpier than the bonds below that. Why is that? Because stocks are more volatile than bonds. And are you going to end up with more in your investment account over time if you're in large companies versus bonds? Looks like it. The top line is small companies. They're more volatile. They have the biggest opportunity for growth. So that is even a more volatile line in there. Are you comfortable with the gyrations along the way, knowing that you could potentially get more over time? That's got to be out. You got to give it some time, not a year or two. You need time in there. But generally, small caps do the best kind of thing. So I wanted to show you the volatility increases as you get more potential return over time. You like that?
I like it.
Okay. So
more potential risk, more potential reward.
There we go. The good news. Most years the market goes up. I already kind of talked about that. This is showing 77% of the time they're up years. This is going back to 1937 through 2017. So and 77 of the time, 80% of the time, the market is up and the other, it is down. And that's just a fact of life. So here it says maybe, we should switch investment strategies. And I hear that from time to time. And here, this is another calm simple little.
I need you to read that line by line.
This is my eye chart. It's not a periodic table of elements in chemistry.
Looks like a
it.
quilt.
It looks, oh yeah. So each year there's, just kind of show you a little bit about it. It starts at 1998 and it's to 2017. Each box represents an investment type. There's large cap is red, large companies, large growth companies. Green, the next one over, is mid-sized companies or growth. Commodities is gray, that's metals and oil and things like that, commodities, things to build and make things. And there are different investment types and et cetera. It goes on and on. So it shows each year which one at the top, the one at the top is the one that did the best for that year. So you can see they switch around. This is just circling how commodities have done. You could say, well, in 1998, you say, well, I better get out of commodities totally. I don't ever want them again. 1999, they're number 4, but 2000, they're number 1 investment. So it changes along the way. It doesn't stay put. And that's what we're looking at again, is how do we structure and change? We are changing our investments, our ETFs, our mutual funds, our stocks. We do a lot of different things to look at, again, what do we think in the next quarter or two? What do we think what's going to do the best? We do make changes along the way, not drastic, but we ease into it. And it's going great.
A little bit of the method behind the madness.
And because we're fiduciaries, we really, our goal is for your account to go up, period. That's it. We don't have our own, investments or anything. That's our goal.
If you win, we win.
Yes. Yeah. So 5 things to do during a market correction.
Panic.
Don't overthink it. Fight those instincts. You need to be diversified, and we're all our portfolios, and you should be diversified. We folks come to us, and they might be in they might have $1 million in several mutual funds. I would say that's not very diversified. You want to make sure you have enough things going on, because all things don't go up and down at the same time either. So you want to make sure that you are diversified. You want to be diversified in the type of investments you're in, but you also want to be diversified in the tax buckets that you're in. And that's another class, but that could be more important than your investment types. We want to make sure we're looking at taxable accounts. Those are like regular investment accounts, tax deferred, your IRAs, 401ks, tax-free Roth IRAs. You want to make sure you're diversifying in those because taxes are pretty low right now, and they really have no place to go but up. So you want to make sure down the road, when you're pulling money out of all those tax deferred accounts, that you got the benefit today because you didn't pay federal and state taxes, that down the road, you don't know how much of that you're going to get to keep. It all depends on what the tax structure is, income taxes down the road. So taxes are important, and we'll have another tax class. We're going to talk about all of that.
We'll have another tax class, and that's one of the things that we do a little bit differently here, is that we do pay really close attention to taxes, because it's not just about how much you make, but how much you get to keep.
Totally.
So we'll have another class on that soon, and then
and we'll probably, as things are proposed and all, we will do that too with the new administration.
Okay. Oh yes. Well, I've got some classes coming up that I'm going to touch on that about, but then I do have one more quiz or one more poll, and this says, how does your current risk dosage make you feel day to day? 1, I don't sleep much and I might be losing some hair. 2, I get risk can mean more reward, but I worry often. 3, I've struck a happy balance. We hope everyone struck a happy balance. Or 4, my mattress knows no bear markets. Also totally legitimate. I did just get a notification here that my link isn't working for that follow-up. So I am actually going to attach it. I did get the document here, and I'm going to attach it. So bear with me for a second.
That's great.
Mom, ramble on about taxes for a minute.
Taxes. Yes. Well, we talk a lot about Roth conversions, and those are more important to think about than they ever were before, because so many things in your retirement are linked to what your income is in retirement. And I mean income from when you're pulling money out of pensions. You might still be working part-time, full-time. of pulling money out of IRAs, 401ks, that counts as income. The more income you have, it could make your Medicare premiums cost more. The more of your Social Security is taxable. There's a lot of things that are linked to income. So if you're pulling money out of Roths, that's not income. That's tax-free. So those things, that analysis is important to look at. And also, I mean, if you convert money from regular IRA to Roth, then it grows tax-free for the rest of your life. Nothing too shabby about that one.
She loves taxes. Oh, good. Look at this. Everyone has struck a happy balance on this call so far. Well, that's really great. We're happy to hear that. I also just offered a handout. Looks like Tom said that he was able to get it. Thanks for that feedback, Tom. But in case you didn't get the handout, once again, I have a little summary of our presentation. I did just pop it into that right-hand side box there. You can click on download, and it is a great little PDF page flipper that reviews what we talked about today that you're welcome to share.
Super.
And
nice job on the technology.
Yes, great.
Very
I
good.
love it. Okay.
So yes, it is a little normal, obviously, to worry about things, but talk to us, call us, get questions on anything. And we've been doing tons of Zoom meetings, phone calls. We're doing a little bit in person. And we have the 2 localities to meet. Let us know what you're thinking. And remember, this is not how to do it.
Don't do this.
Don't do that.
Don't be dyslexic investor.
So in closing, starting to close here, we said, that being said, if what you're in is too volatile and you need to sit down with us, and that's why we have at least annual reviews. If the volatility is too much going forward, we can reduce the risk. We can, instead of certain types of investments, we can do things that are less volatile. We can do things that have no volatility. We do things with fixed annuities. There's some types of fixed annuities that are like CDs, but they get a higher rate of return. Then there's things that are called index annuities.
Do you have a fixed? You do have a fixed annuity thing in here, yeah, but we're not quite to closing it because you did have this little graph here that explains what you're talking about with fixed annuities.
Another simple graph.
This one's a little bit better, but it's still tiny. We need to work on that.
Yeah, it is. But
she knows what these lines are, though.
I do. I didn't even have to look.
Okay, ready? Go.
So index annuities. I mean, they're kind of neat because they're totally safe, and they can produce kind of like a guaranteed income stream down the road. Or you can just put your money in there and they go up when the market goes up, market goes down. You don't lose anything. There's caps on them and all that kind of stuff. But the red line is showing the stock market, up and down of the stock market. The blue line, the green line is this particular fixed indexed annuity, what it had done over time. And blue line is the minimum guarantee. So there's some things out there other than bank products, which CDs.
And your mattress.
In your mattress.
There are other ways.
Yeah. Envelopes in your drawer. Someone, I think, Amanda told us that.
Somebody, yeah. There are better ways, folks, to stay safe.
I love
to have a safer option for your money, and that's why we talk about index annuities, which are insurance products.
They are, and so they're. We like to present all types of ideas, tell you the pros and cons, and let you make the decision, basically. Yes, we are here for you.
We're here for you. Call us. I have a little slide here that has our upcoming webinars. We would love for you to join us on our upcoming webinars. February 12th, we have Saving and Investing in 2021. And this is an opportunity for Joanne to just talk about what's really current, maybe some new policy ideas, things that we think are going to be helpful moving forward as we move into this very different year, hopefully much better year in 2021. So it's really just going to be a lot of now, what's happening now and what you can kind of gear up for. So we're excited for that. You never know what she's going to throw in on that one. It's going to be a grab bag. And then let's see.
Our Social Security and income planning, our one we've been doing for
1 million years.
In 11 years.
We've done this one a lot.
And we did that. I started that before anyone else was doing it because Social Security laws change all the time. And they're complicated, and they shouldn't be, but they are. So I thought we better do a class. And income planning is really, how do you replace your paycheck when you retire?
So if you know anyone who is turning Social Security age, I'll say that's kind of a range. But if you know someone who's maybe been chatting with you about their Social Security options and maybe having some doubt, please feel free to forward them the email that you get after this, or the email that you got to register for this. And please encourage them to sign up, because it is a really great overview crash course on Social Security.
It's important.
It's important. And then the last one we have here, March 11th, is how to rock your 401k IRA. We have Amanda on the call today, and Amanda opened Joanne's eyes to how there is really a need for us to understand a little bit better how some of our retirement plans work and how to really make the most of them. So that's what we're going to be talking about on March 11th.
Yes, what they are, how to maximize, how to really how to look at things and not make mistakes, and what are the rules, and what does this mean and that mean on your statement, all those kinds of things that, looks like Greek, right? A lot of times the statements, right? Mm-hmm. So we're going to
break it down.
Kind of go through that.
Yeah. So at the bottom of your screen is a link to see the future webinars. If you are on this webinar, that means that you probably got an email advertising it. If you have not gotten an email advertising it, you will get a follow-up email with the recording to this. And you please sign up for our announcements. We try to keep the topics really current and relevant, and our goal is to be a resource in the community for education. So we really want to invite anybody who wants to learn. Amanda says financial literacy is so lacking, and we totally agree. And we think that it's one of the tools that can empower us all to have a better financial future. So we really want people to get educated and to ask questions and get involved and learn about their finances.
Yeah, it's within all our reach to retire at some point financially secure if we just know some of these rules. So we really do want to spread the word, all ages.
Mm-hmm. And if you're watching a recorded version of this, there is a link beneath the video that you can click to schedule a complimentary consultation with this gal right here. We'd love to meet with you over the phone or Zoom, or depending on when you're watching this, possibly in person. But we'd love to help you. We'd love to meet with you and give you some tips and
yes, ma'am,
bring you into the future.
Yeah.
So thank you, Shelley. Thanks. She says we make a great team. Thanks so much for watching, guys.
Yeah, thanks,
have a wonderful
everyone.
rest of your day, and we will see you next time.
Take care.